Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Airbnb stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 105 billion market cap. They're trading at 165 a share, and they have 636 million shares outstanding. Airbnb is an online marketplace for short and long-term home rentals. The company acts as a broker and charges a commission for each booking. Airbnb is shortened for its original name, AirBedandBreakfast.com. They are number one in the short-term housing rental space. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They still had negative free cash flow in 2020. Their revenue was kind of low, but they really hit their stride. 2.3 billion in 2021, 3.4 billion in 2022, and then 3.9 billion in 2023. They bring in a lot of cash flow. Their free cash flow margin is 39%. And it's been that number for 3 straight years. That means they convert nearly 40% of their revenue into free cash flow. Really profitable business. Net income is the profit or loss on the income statement. It's revenue minus expenses. A really big negative in 2020, a smaller negative in 2022, then a nice gain of 1.9 billion in 2022, then it blew up in 2023, almost tripling to close to 5 billion. Then net profit margins of 48%. That's a really strong net profit margin. 20% is good. Revenue is a sales for the company, and that grows a lot year to year, from 3.4 billion to 10 billion. It grew 77% in 2021, 40% in 2022, only 18% in 2023. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 109 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $97 billion. We divide that by 636 million shares. And we get a calculated stock price of 152. They're trading at 165, so they're trading at an 8% premium. It's a sell according to the model. Even though they do have a high market cap, 100 billion, I think it's worth it, or really close. If they continue growing at this rate, I don't see a reason it can't be a 500 billion market cap company in 3 to 4 years. There are 17 companies in the same industry as Airbnb, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend anything in CapEx because they don't own any homes. The people who rent out the homes own them. They're just an online marketplace. They have a low debt to equity ratio, 0.3. For every dollar of equity, they have 30 cents of debt. They generate a lot of free cash flow, second highest on this list. They rank second in market cap. Booking is number 1, a little bigger. Price to book is a little high. Price to book is stock price over book value per share. They're trading at 12 times book value. PE looks pretty good, 22, better than the median average. They're trading at 22 times earnings. Price to free cash flow is at the median. They're trading at 27 times free cash flow. Their price to sales is high, highest in this industry. They're trading at almost 11 times revenue. But they're really profitable. So even though their revenue is lower than RCL, CCL, and Expedia, their free cash flow is almost equal to the 3 combined. And the reason the stock price keeps going up is because they're growing so much. Their revenue is growing at a 22% clip, much more than anybody else in this industry. If you put $10,000 into this company when they started trading, you would have been up 50% right away. Then you would have been in the red, down about 30% at the worst point. But if you're still holding, you'd be up a little bit right now. Your $10,000 would be close to $12,000 today. It's not too bad, a 5% annual return, 17% total return. Let's take a look at their 10K. We'll start with their income statement. This is 2021, 2022, and 2023. So you can see revenue goes up a lot each year from 6 billion to 9.9 billion. They give a breakdown of the revenue by location. North America, 4.6 billion. EMEA, Europe, Middle East, and Africa, 3.6 billion. Latin America, 800 million. APAC, 800 million. The great thing about a company like this is it's easy for them to scale and grow into other locations. They don't need any infrastructure. A little less than half their revenue is in North America. A little more than 1/3 is in EMEA. So they have really good diversification. The gross booking value, 35 billion in North America. This is how much money people pay others to stay at their Airbnbs. And this company takes a cut of that. So of the 35 billion, they got 4.6 billion in fees. There were more nights booked in EMEA, 187 million, than North America, 146 million. Each night is cheaper in EMEA. That's why gross booking value and this company's revenue is lower. North America is much more expensive per night. So only 1/3 of the nights booked were in North America, but that brought in half their revenue. Let's go back to the income statement. Cost of revenue, 1.7 billion. These are all the expenses directly tied to generating the revenue. Operations, 1.2 billion. Product development, 1.7 billion. Sales and marketing, 1.8. G&A, 2 billion. So operating expenses, 8.4 billion. Operating income, 1.5 billion. That's down from last year of 1.8 billion. So maybe they're not as profitable as I thought. But the reason their net income is higher in 2023 is because interest rates are higher and they're getting more interest income on their investments. Interest income last year, 186 million. This year, 720 million, up nearly 300%. Interest income consists of interest earned on our cash equivalents, marketable securities, and amounts held on behalf of customers. So customers pay them and they hold that money and earn interest on that cash because they put the money into a savings account, into corporate bonds, commercial papers, really safe, low-risk investments. That's why during inflationary periods, banks and insurance companies make a lot more money because they tend to hold a lot of cash. Companies like PayPal, eBay, Venmo, they hold lots of cash as well. Let's go back to the income statement. So it looks like the big reason for the gain in 2023 was they had a $2.7 billion income tax benefit. And if we search this number, we can see most of that benefit was federal taxes, 2.4 billion. State as well, $500 million. The income tax benefit was mainly due to a release of 2.9 billion of our valuation allowance related to our U.S. deferred tax asset. So their EPS is really high, $7.52 compared to $3 last year. In 2021, they had 616 million shares outstanding. 2022 and 2023, 637 million. But they did decrease their diluted shares. They had 680 million, now 662 million. Let's look at the balance sheet. 16 billion of current assets. 10 billion of current liabilities, so a high current ratio, above 1. They have 10 billion of cash and short-term investments. That's why they have so much interest, because they're investing that money. Deferred tax asset, 2.9 billion. That's what resulted in the big gain. So total assets, 21 billion compared to 16 billion last year. Total liabilities, 12 billion compared to 10 billion last year. The biggest liability is funds payable. This is how much money they owe customers. They owe the people who are renting out their homes or apartments. Because when someone's renting someone's home or apartment, they pay Airbnb. Then Airbnb pays the person who's renting out their home. They do have 2 billion of long-term debt, which is not a lot since they have so much more cash on their balance sheet. Assets minus liabilities equals equity, 8.2 billion of equity. It's up from 5.6 billion last year. They raised 12 billion from selling their business. They lost 3.4 billion from running the business. But their accumulated deficit is getting better. Probably by next year, it should be positive. Let's look at a statement of cash flows. In 2023, they had 3.9 billion of operating cash flow. The way you calculate operating cash flow, you start with your net income, 4.8 billion. Then we add back the non-cash expenses on the income statement. We add back stock-based compensation. We have to minus the deferred income taxes because that was a gain. That was a non-cash gain, so we minus it out here. The purpose of operating cash flow is to convert net income into cash. Not much going on in the investing section, just a lot of purchasing and selling of short-term investments. In their financing section, they paid 1.2 billion of taxes on equity awards. So when they give out so much stock-based compensation, they don't have to pay for the stock because it's their stock, but they do pay taxes on it. And they bought back a lot of common stock, $2.3 billion last year, $1.5 billion. Let's take a look at the stock on Simply Wall Street. Its last price, $165, $105 billion market cap, up 3% in the past week, up 39% in the past year. Let's see what they say about the company. Airbnb operates a platform that enables hosts to offer stays and experiences to guests worldwide. Their marketplace connects hosts and guests online or through mobile devices to book spaces and experiences. It mainly offers private rooms, primary homes, and vacation homes. They used to be known as Air Bed and Breakfast Inc. and changed its name to Airbnb. They were founded in 2007, headquartered in San Francisco, California. It looks like they IPO'd at the end of 2020, and the stock is up only a little bit since that point. It traded in a fairly tight range. It did break through 200 a couple of times. Its low was 86. That was at the end of 2022. So it's a pretty expensive stock. Simply Wall Street's price is 208. They say it's 21% undervalued. 35 analysts priced this stock at 145. They say it's overvalued. Their revenue is projected to grow each year up to $13.9 billion by 2026. And their free cash flow is also projected to grow a little bit, up to $5.1 billion in 2026. They didn't have any debt in 2019, added a couple of billion in 2021, and it's still at that point. When you look at their equity looks a lot better than their debt. Equity over $8 billion. But they have so much cash on their balance sheet, they're all cash. Their cash is higher than their equity. That's the green line here. In 2019, the CEO got paid $110,000. Now he gets paid $1. Those are the types of CEOs I like to invest in. His tenure as CEO is 16 years, total compensation $300,000. Their employee count went from 5,500 in 2020 to 6,900 currently. And the ticker trades on the Deutsche Börse, Wiener Börse, Mexican Bolsa, Nasdaq, Xetra, London Stock Exchange, BATS Europe, Sao Paulo Bolsa, and the Buenos Aires Stock Exchange. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.